So what's the difference between a mutual fund and an ETF or exchange traded fund? Well, mutual funds were created around 1924. ETFs didn't really start until maybe the 70s or 80s and pick up steam really in the last 20 years. So a mutual fund is, if you think about it, it's a wrapper that holds stocks and bonds generally, and a manager will trade in and out of those positions. One key tax component is that a mutual fund has to distribute 95% of its capital gains to shareholders. So they can produce some tax byproducts that you might not expect at the end of every year. An ETF, by contrast, doesn't really trade those positions, meaning buy and sell them. They tend to exchange them in a pool with other market participants. So that doesn't trigger the same capital gains distribution rules. So there can be more tax control with ETFs. ETFs tend to be what we call closed-ended, whereas mutual funds are open-ended, meaning a mutual fund can create more shares of itself as more and more investors come in. An ETF is closed or holds a basket of stocks or bonds, and so it is listed on an exchange like a stock and can move intraday up and down based on participants buying and selling those. Now, a downside of an ETF comes into place when you have maybe more exotic holdings in it. So maybe a small cap ETF. It could have less liquidity because it is closed in nature and new shares can't be created. If there's not a lot of open interest or buying and selling of that small cap ETF, then liquidity could dry up and it could be difficult to sell your shares in the future. So we always go back to no investment is perfect. Every investment has a series of pluses and negatives, trade-offs. And so it's best to educate yourself about all of these so you can build a diversified portfolio of investments, which are really tools that support your goals and objectives. Those goals and objectives should be well matched and recorded in a well-crafted financial plan.